Hey everybody, this is Rob Keens of goldsilverpros.com. I have a very special first-time guest with the program. It is Craig Hemke, he of the TF Metals Report. Since 2010, he's been the editor and publisher of TF Metals Report, found at tfmetalsreport.com, an online community for precious metals investors. And prior to starting TF Metals Report, he had a career in the financial services through the 1990s, but retired in 2008 to focus on family and entrepreneurial opportunities. Craig, how are you doing today?
Hey, Rob, it is such a pleasure to get a chance to visit with you. I've admired your work from afar for a number of years, and I don't know why. It's like we're like a Venn diagram where the circles didn't intersect somehow.
That's right.
So
well, glad we finally got a chance to talk. I know we've been hinting around it for a little while, and again, I followed your work for a long time. I think you've been talking about what I've been talking about for a lot longer, and bringing light to what goes on really in the precious metals world behind the scenes. And if anything, I think that's where you really shine.
Well, thank you. I appreciate it.
So I wanted to just talk about some topics that you've written about recently and covered recently. So before the show started, you and I were chatting about some of your articles. Of course, you're at Gold Eagle and many other places as well. You had one back in April called Gold Suddenly Gets Really Interesting. And I think that had to do with interest rates. And we have some maybe new interest rate data coming up. So I wonder if you wanted to chat about that and what you think the potential impact interest rate changes could be on the gold market.
Yeah, Rob, that's, I think, fundamentally a very important point. You know, I've raged against the pricing scheme now for over a decade, as you point out, because I think it's totally unfair and it's a gross distortion. You know, you go back to the history of gold pricing and silver pricing too, for that matter. The world tried to live on a physical only, exchange an ounce for $1 type of thing, all the way up till 1968 when the gold pool failed, the London gold pool failed. Anybody that doesn't know about that, just Google that term, London gold pool, and go from there. Then, of course, Nixon suspended the convertibility of the dollar into gold in 1971. And then in 1975, because there's not enough physical metal laying around to keep price from just totally exploding higher, we started getting into alchemy, where, you get these alternatives, these substitutes being offered, synthetic, pretend, make-believe metal, good as gold, price exposure, where there's futures contracts, eventually get into ETFs, and unallocated accounts and the like. Even in this pricing scheme, Rob, the most significant long-term correlation is real interest rates, not the nominal rate, okay? Not, if the 10-year treasury note is 6% and the inflation rate is 2%, then the inflation adjusted return on your 10-year treasury is 4%. Well, hot damn, that's a pretty good deal, right? If you're a big institution, if you are an insurance company, a pension fund, whatever, that's the bedrock of your portfolio is a 10-year treasury. Well, where it gets interesting is when that gets upside down and your 10-year treasury at present is 1.6%, but your latest inflation numbers as of last month were 2.6% on this annualized CPI. Now, all of a sudden, if your 10-year treasury is guaranteeing you a 1% loss of your purchasing power every year, now all of a sudden that 10-year treasury doesn't look so hot. And it provides the alternative for other investments to compete with that, even in the eyes of, the traditional monetary financial system, hedge fund, asset allocator, all that kind of stuff. Because, the argument against gold, Rob, is that it doesn't pay a dividend, right? Right. Even has a negative carry cost. Well, that sure beats the heck out of a guaranteed 1% loss in a treasury. So those negative inflation adjusted interest rates are the strongest correlation with gold, not just inflation, because if the 10-year treasury is at 5% and inflation's at 5%, well, then it's zero. So it's not just a stated inflation number. It's using inflation to come up with a real interest rate. And that's where we are. Gold's been surging now for the last 6 weeks. Because of this, we're going to get another latest updated CPI this week. It's going to continue to be strong because in the rolling 12 months, April of 2020 was a pretty weak month. We're all in lockdown and shutting down. You kick out April 2020, you add April 2021 into the 12-month calculation. We're going to get another set of big numbers this week, and we'll just have to see how the bond market reacts to find out if we're going to have a good week in gold too.
Yeah, and that's interesting. You bring up inflation. We've been looking at the commodities charts, and we have commodities just exploding all over the place. Yep. Interestingly, other than gold and silver, but everything else is exploding. What do you think the long-term outlook is? Well, not long-term, but the next few months in a rising inflation environment.
Yeah, there's two things, Rob. The key to my forecast, and I've had a good. I don't know if you put out annual forecast, Rob, but it's kind of a stupid thing to do. Because if you're right, everybody says, well, geez, anybody could have seen that coming, don't hurt yourself patting yourself on the back. And if you're wrong, you give food for the trolls, until your dying days. But my last couple of years of annual forecast been pretty well spot on, because I picked up on this trend in late 2018 of falling real interest rates. The Fed was going to have to change policy. You saw that in late 2018, and they did obviously in 2019. The Fed now is moving toward a policy of yield curve control, where they're going to have to cap long-term interest rates. But the last thing they want to do is come out on a Wednesday morning and say, we hereby decree we're not going to allow long-term interest rates past 2% on the 10-year. They're going to try to jawbone that first, and give an implied message that they're uncomfortable with that. Well, the first part of that, very first step in that direction is putting out this notion that inflation is transitory. And you hear that, we've all heard that ad nauseum in the last month. And why is that yield curve control? That's the first step toward yield curve control, because Powell and the Fed are trying to convince the bond market not to sell off. Yield curve control. They're trying to get bond investors to say, yeah, I see the CPI at 2.6, but I'll go ahead and still buy treasuries at 1.6 because Powell has assured me that it's going to come back down under 2% in the months ahead. Well, the problem is it's not. For people, and you've got a really smart audience. And so whether they ever took an economics class or not, you may recall that, back in the day when they taught us this stuff, there were two primary drivers of inflation. One was called demand pull, and the other one was called cost push. And those were what would drive inflation. And now all of a sudden we've got both. We've got input costs pushing inflation higher, iron ore, lumber, the grains, hogs, sugar, corn, which is high fructose corn syrup and everything. All of these things are up 70, 80, even 300% in the last 12 months. Input costs have to get passed along by the user of those to the producer. Otherwise, their margins get squeezed. They don't make any money, and they go out of business. So costs get passed along to consumers. That pushes inflation higher. But then the other part of that is demand pull. That's the classic too many dollars chasing too few goods. And buried within that jobs report back on Friday was a note that average hourly earnings had risen by 0.7%. And even that's not enough to attract people to the job market. It was a hugely disappointing jobs number. So wages are going to go up again. We got all this movement. McDonald's workers are going to go on strike Wednesday for $15 an hour. Mm-hmm. All of that just makes more dollars out there in terms of wages chasing, again, too few goods. So now it's a double barrel thing. You got the demand pull and the cost push, which means it's not transitory. And right. that's gonna drive Powell then into his next step of yield curve control in the months to come.
Yeah, you mentioned maybe people not going back to work or the disappointing job numbers. Chris Marcus and I were out in Vegas, I guess a month or so ago, and just having a little weekend there, having a little bit of fun, much needed break. And yeah, we couldn't get a cab. We couldn't get any of the driving services, Lyft, to pick us up. And I spoke to one of the cab drivers. Is like, people are staying home playing video games because they're getting government money, and the wages aren't high enough for driving a cab or doing Uber or Lyft to draw people out. And we did a video on that called the Las Vegas Taxi Cab Economy, and I wonder how much we're going to see that across the economy, Craig, as this inflation picks up and the wages aren't keeping up with it.
Yeah, no doubt. And then throw on top of that, there's maybe job openings now. I think we'll get the latest job opening data this week. But going forward, how many additional job openings will there be? Because you look around, just pick your average, office for a company here in the US that used to take up, 10,000 square feet of office space, for their 250 employees or whatever like that. And then they sent everybody home for a year and now have gotten used to, maybe we only need half this space. Maybe we don't even need this many employees, but we certainly don't need this much space. And you factor in all these different components in this bounce back from this, what will end up being a massive change to how things get done by COVID. And I have thought, I first started talking about stagflation about a year ago at this time, because we're still down 9 million, 10 million BLS jobs from last year. Man, the idea that we're going to go back to some kind of roaring economy, if we ever had one in the first place a couple of years ago, I just think is far-fetched. And so we're headed down this road of stagflation, where you just kind of sputtering along with growth, but with inflation because of all of the monetary policies and everything they got to do to keep the plate spinning. And it doesn't have to be a 1970 style stagflation to drive gold to the multiples higher. I just watch those real interest rates, because back in that stagflation of the 70s, interest rates were maybe 10% on a 10-year treasury, but inflation was 15. Well, there's your -5. So what if we go to 2% on a 10-year treasury, but inflation is 6? Well, there's -4. And in the late 70s, gold went from $100 to $900 in about 3.5 years. So there's certainly precedent, and you can kind of see the basis is why I, even in this pricing scheme, am bullish for higher prices for both metals.
Yeah, I agree with you wholeheartedly. My study of gold, it's the negative interest rates that really tends to drive those values, and I see it as being a big driver. I wanted to get maybe more into the logistics of the market in an article you wrote here on May 5th at Gold Eagle, the COMEX Gold Delivery Update. Can you just give us the rundown of what you were seeing there in terms of the deliveries and gold coming off of COMEX, and what your view is?
Well, it's it's been fascinating to observe the last 12 months. And really, I've been watching this stuff week by week, month by month, delivery month by delivery month, which is every 2 months for 10 years now. And until about middle part of 2019, maybe into very late 2019, the COMEX was, they trade derivatives there, which are unhinged from any physical reality, because there was never any delivery. There was some, maybe 5,000 gold contracts of 500,000 contracts of open interest, so 1%. And the actual, they would say was delivery, was just a shuffling of warehouse receipts. Here, I'll assign this to you from one bank to the next, and then 2 months later, that bank reassigns it back to the other bank. And it was like this illusion, this shell game, to create an illusion of physical delivery, because without physical delivery at your derivative price, then what do you have? You're just trading baseball cards, right? They have to have some physical, say, oh no, look, there's delivery happening at this price that we found through trading derivatives, so therefore it's legitimate. If you don't have any physical delivery at all, well then hell, trade your baseball cards for whatever you want. So that system, there were never more than 8 million ounces in the COMEX vaults, about 1 million in registered and 7 million in eligible, and it might move around, but it never really changed. And the deliveries were always the same. And I listed them out the last 5 or 6 years in that article, if anybody wants to see them, because I've got all the data. Well, the banks started to really abuse this kind of arcane process within the COMEX system pricing scheme called exchange for physical, where they were playing off the futures contracts in the spot and kind of arbing the difference. And this just exploded to where we were doing thousands and thousands of metric tons, like 7,000 metric tons in 2019 of these exchanges for physical. They're just not, it was ridiculous. Ronan Manley, has dissected all the numbers that the LBMA puts out, and they maybe have 700 tons in London that isn't assigned to Bank of England or to the ETFs. They just completely abused this process all the way up until everything broke in March of 2020. Remember, that was when the futures were trading like at $100 premium to spot. Remember that?
Yeah.
And why? Because all of a sudden these banks that make the markets, and shuffle all the metal around, They didn't have a confidence in future delivery at all. Because again, if you knew that you could sell a futures contract and buy it spot and deliver it a month from now versus that contract you sold, well, that whole spread would close. But nobody was doing it. Why? Because they weren't confident that if I bought it spot today, you'd get me the metal in time that I could deliver it a month from now. And so that's why that spread got so wide. And so the whole market basically changed at that point. Everybody lost confidence. And now those spreads have come down, but nonetheless, what that was indicative of was this idea that, there's not as much metal here when push comes to shove as what everybody thinks, what everybody pretends. Again, now to shore up confidence in the CME and in their COMEX, they started rolling out all these brand new contracts, where you could take delivery of fractional ownership of a bar in London. All this, it's just rigmarole, mumbo jumbo. And at that point, the deliveries on the COMEX just exploded. And where we used to do 5,000 deliveries in a month, suddenly we did 50,000. Mm-hmm. And where the average, in a year might be, I don't know what the numbers might be, 25,000, 30,000 contracts. All of a sudden we're doing that many in a month. And it hasn't changed. And so to me, that's still indicative of extraordinarily tight physical market where the COMEX now has become a place where you can go to get physical metal. This was not the way it was designed 45 years ago. Mm-hmm. But because things are so tight, people are using it that way. And anyway, I'm sorry for the long answer, but that's kind of what that article is about. And the main value of it is probably for people to look at it and see for their own eyes how much things have changed from 15 and 16 into 18, 19, and now today. It's just extraordinary.
Yeah. And the last part of that article, you go on to say that the silver squeeze movement that happened could happen to gold as well, because it's subject to the same basically market dynamics. And we saw, just to reset for people, the silver squeeze movement back late January, February, pulled 110 million ounces out of London OTC and into the coffers of SLV. The LBMA came out with a report sometime later, spring 2021 silver report, in which they said we were almost bankrupt of liquid silver. They had 360 million ounces left, which is about 2 more weeks if that trade had continued. So London seems to have not, it's obviously a derivative market. It's not flush with silver. Could that same thing happen in the COMEX in silver and gold, where they basically run out of available stocks?
Yeah, no doubt about it. We've already seen this happen. This process that I hope we're going through, we've already seen this happen in palladium. And I was writing about this extensively over the last, all the way up. Palladium went from 500 to 2,500 in about 3 years. And there's a guy named David Jensen, who I know, who's a mining analyst and mining executive in Canada. And he was tracking this and getting some samples of what lease rates were in London. And it was very obvious in the 17 to 19 period that the palladium market, which is structured the same way as gold and silver, with deliveries in London, but futures trading in New York, the palladium market was running out of metal. You had this kind of new Cold War with Russia. Russia produces like 40% of the world's palladium. There was a real squeeze in supply. Open interest in COMEX palladium declined rapidly. The bank net positions where they'd been heavily short evened out to flat. Banks just pretty much got out of the business, said, we don't want any part of this because there's no physical palladium. And palladium kind of topped out around 2,500 for a long time. Now it's surging again to new all-time highs. That's what we want to see happen in silver and gold too, because they're structured the same way. What I used to call it Mr. Palladium, like Dr. Copper, because I was hoping people would see what happened in palladium and go, well, shit, if that's the case in palladium, well, and they price gold and silver the same way, well, maybe we should squeeze them too. Maybe there's a chance, to get people to realize. And that's what the silver squeeze movement has done. It's harder to squeeze gold because it's expensive. To organize a movement of everybody to buy, a couple of gold eagles, we're talking, 5, 6, 7, 8, 10 grand. But people can chip in silver and buy a tube for $600. And so, again, what we're doing is like palladium. We're drawing attention to both of these markets by saying, well, look at, there's nothing left. And it's all this phony baloney, derivative contracts and Look at the spread between spot and physical and what you have to pay for a premium to buy it and get your hands on it and all that kind of stuff. And what we're really doing is pulling back the curtain to the point where hopefully it gains critical mass. Palladium didn't quite do that, but if silver does, then that'll definitely impact gold and vice versa. So we just got to keep the pressure on. Every ounce you buy, I buy, anybody listening to us buys, removes it from the hands of the bankers and stretches that rubber band of leverage even further. And we just got to stretch it so far enough to where it breaks and people, realize what thing's been a scam the whole time.
So if that market breaks for silver, what do you suspect happens? Do you think that somebody else steps in? Is another market going to take over that trading that's more physical oriented, or what happens to these derivative markets? They've been in place for so long that people have just relied upon.
Yeah, your guess is as good as mine, Rob. I don't know what will supplant it. It's some type of physical trading, and I don't have any problem with leverage. I don't have any problem with maintaining a market where that has some futures in the original design, where maybe a mining company or a farmer, that needs to sell forward some future production, to kind of lock in a price. So you know what, I'm good at $7 of selling my corn that I'm going to grow this season at $7 a bushel. That's fine with me. That makes me a profit, all that kind of stuff. And then the speculator takes the other side of that trade, long or short, fine. But in the current system, where we have no idea, none, how many true owners, beneficial owners there are for every single ounce of not only gold, but silver too. I mean, that's a bastardization of the whole process. Oh, and imagine that the banks are involved and they've done that. That never happened before. So when it resets, what happens? I would imagine you get back to, a system that's more closely hinged to a true physical exchange price, where I've got this ounce of silver. What do you give me for it? No, I don't want to trade it. How many dollars are you going to give me for this ounce of silver? That's not what the system is today, but it heads in some kind of direction like that in the future.
So what do you think is next? I'm going to ask you a forward-thinking question. I'm going to leave it open and let you speak about whatever you want to speak about to finish the conversation. What do you think is next for the precious metals market? So if you look in your crystal ball.
Well, the hard part is it's kind of like the Big Short guys, right? Mm-hmm. In the book is fantastic, even better than the movie. They were right. They just had to wait it out, and you got those scenes in the movie. They're like, I can't believe this stuff still. I mean, what am I missing here? And I've been doing that. I remember I was in London in 2016 and I met Andrew Maguire for lunch. And then we went on the Kaiser report that afternoon. And we were sitting there talking at lunch about this, about how, and it was the same conversation. It was, look, this is going to happen. The hard part is you don't know when. It's like those guys in the Big Short. They knew they were right. They just had to wait for, the trigger, and then all of a sudden everybody wakes up, and then there's these margin calls and the rest. So I don't know how long it will take. I mean, it may be something that, again, we have enough demand in silver that suddenly the world wakes up to it, like they did with, a GameStop or some of the other things that are going on these days. But it will happen eventually, because the math is the math, right? There's no way the Fed can allow real interest rates to go positive if they're going to fight the record levels of debt to GDP and all the rest. And eventually that's going to drive more people into precious metal, and that's going to create even more physical demand because people want to own it when it goes up rather than when it goes, is on sale, which is unlike any other good anywhere. And so eventually the thing just kind of starts to feed on itself and roll, and more demand. It makes the stress even greater on the banks who are trying to, flow metal around the planet to meet, the metal at the price that's determined in their phony baloney exchanges. And we get to that point. The only thing that I can't tell you, Rob, is there's two things I can't tell you. One, when that's going to finally happen. I just know it will, which is why I just keep buying physical metal almost every single month. And then I don't know what the price is. I've gotten that for a decade. Well, what's the right price for gold? I have no freaking idea what the right price is, because the gold price that you're asking me about is dollars per ounce. Well, I don't know how many ounces there are. When the system is levered 10, 50, whatever times, and we have to know how many people think they own the same ounce. And so when it's determined that one person does and there's 25 other people left holding the bag or whatever it is, well, they're going to be pissed. And those people are all going to want their own ounce to replace it. So I don't know. I mean, you just don't know how many ounces there are. So if I don't know what what that denominator is, I couldn't possibly tell you what the price is. I just know it's not 1,842 or whatever it is as we speak.
Yeah, I agree with you. I think we had that pullback after gold popped over 2,000. And I think it was just, a lot of people were worried about that. And I think it was just a normal correction. I've talked about the cup and handle pattern thousands of times. It looked to me like a long-term bullish pattern on the chart. Looks like we've broken through that. We've broken through all the technical lines. Basically, we needed to break through. Are you thinking that we head up more, towards the $2,500, $3,000 range, or what are your thoughts on that?
Well, my forecast this year, the last couple of years have been pretty solid. I thought we'd get to 1,900, 1,920, and 19. That's exactly where we got to. I thought we'd get to 1,800 last year. Didn't anticipate COVID, so obviously we got beyond that. And for a number of reasons, I thought we'd get to 23 this year, starting from 1,900 at the beginning of the year. I still think that's on track. You mentioned the pullback. Again, I just relate it back to real interest rates. We were -1 to -1.1 last August. Again, taking the 10-year note yield minus inflation, 0.6 minus 1.6 back last August, and the price was $2,100. So now we're back to -0.1 and price is $1,800. That's a market inefficiency that's going to be fixed. In 2019, when we were in the beginning stages of this current move, which began in 18, twice price consolidated and flagged underneath the 50-day moving average. The two times it moved above, it rallied 19% in about 70 days in the spring. It rallied 13% in about 70 days in the late year in the winter. So we moved above the 50-day when we got above 1750. 3 weeks ago, maybe? And at that point, I thought, okay, well, another 15% rally in the next 70 days should take us back to 2,000. So I think that's where we go. And then it's just a function of how aggressive the Fed has to get with yield curve control the rest of the year. So I think we continue to have a very good year. And boy, the mining shares too, as you know, those things, man, when they catch on, they're all breaking out. They're all, the GDX is now back above its 200-day moving average. Once gold gets above its 200-day, which is up around 1,850, that's going to really get people going, whoa, wow, the train's leaving the station. And then the thing kind of feeds on itself. And last year, there's one last point on that. Gold traded on the way up to 2,100. Gold was in a range this time of the year last year between 1,680 and 1,780. It was about 100 days. Bottomed out on June the 5th after a jobs report Friday, and then broke out by later in June above 1,780. And then it went to 2,080 in about, like 6 weeks. I mean, we all sat around going, well, what the hell's wrong with silver? Silver's still trading $18 until early July. And then it went to 28 in like 4 weeks. So we've all been frustrated, and this consolidation has gone longer than I thought it would. But again, once it starts breaking out again, things can really catch fire and get a lot of upward momentum pretty quick. And I think people need to be aware that that's kind of where we are right now.
Yeah, I pretty much agree with you 100%. I don't have anything to argue with. And Craig, I want to say thank you so much for stopping by the program. Like I said, it's been an absolute pleasure speaking with you. And
Rob, I'm just so glad we finally got a chance to know each other. I'll have to have you come back on my site as well and get to know everybody there, because we have a lot of fun. We don't just take it so seriously all the time. Man, there's some of these newsletter subscriptions where all they do, is just roll out price forecasts and all that. Man, if I had done that for the last 12 years, I'd have quit 5 years ago.
That's right.
We all realize we're all in the same boat, man.
Yeah.
The math is the math, and we all have to help each other prepare for these events. And that's what TF Metals Report is all about. So I think I'll have to have you come on, because I think you'd enjoy getting to know everybody there too. So thank you.
Yeah, absolutely would. And so you mentioned TF Metals. Tell people how they can subscribe to your newsletter.
I just go to the site, tfmetalsreport.com. There's a subscribe button, explains it to you. I mean, it's only, I try to keep it affordable, it's $15 a month. So it's about 50 cents a day. I do analysis every morning and I do a summary podcast every afternoon, but in between, the real value is just having a chance to be a part of the site. There's the community is global. It's not just US. I mean, it's geez. My accountant asked me every year, how come your credit card fees are so high? Because I'm like, look, I got people from all around the world that are part of this site. And again, all different political stripes, all different backgrounds, but everybody recognizes we're all in the same boat. And so the information that the subscribers and members share over the course of the day is probably more valuable than what I do. So I'm just really proud of everybody there and what it's become over the last 10 years. So I just encourage everybody to check it out, tfmetallsreport.com.
Thank you again, Craig. We'll have you back on. Appreciate it.
Rob, it will be a pleasure to visit with you again. All the best, my friend.